If your dream is to quit your day job and trade for a living, this trading series is for you. My goal is to show you guys how you can generate a full-time income trading options. Now, with this particular series, the goal is to make over $1,000 every single week with a capital of $125,000. And every single week, I come back, produce the video to show you guys how much money I've made, all the trades I've done with screenshots, as well as showing you why I've been placing those trades. So if you like this content, make sure you like and subscribe and hit that bell notification because I'm producing weekly videos, and the full playlist is down below so you can binge watch all the way back from week one. Now, for those of you who have been following me right from the beginning, will notice two things. The first thing is the amount of money I brought in week 22 is the highest I've brought in since I've started this challenge. And secondly, I've had about 10 to 12K in available capital to trade. I've been holding that back, and a lot of you guys have been asking me to sell another Tesla put. I've done that kind of. So all will be revealed in this video about the new option trade that and the new strategy even that I've decided to deploy in this challenge to generate more premium and to kind of call back the deficit that I've been making. So let's head right into it. Week 22, $19,000, not 19, $1,900 or nearly $2,000 for the week, which is the highest I've ever had, 92% above the target, which is absolutely fantastic. One caveat I will say to this is when we go into talking about that brand new strategy that I've implemented, I will be buying back these options. Well, the plan is to buy back these options when I've hit about 50 to 60% of the actual profit. So as a premium seller, you get the premium up front, and only until the trade is actually closed, you realize that that you realize that actual premium. So I'm planning on actually giving some of this back. So hopefully it will normalize itself out that I will have made more money. So this is overinflating slightly how much money that I've made. So I will caveat that. That is money in there. I could potentially lose out on this particular trade, but we'll walk through that as the weeks go by. And then how's that reflected on a year to date perspective? We've hit the $20,000 mark, which is great. And due to the amount of money I've made, I've crawled back into the single digits of variance, which we didn't hit all the way back until week 4, which is absolutely brilliant. So overall, quite happy with where things are going. Not happy with the stocks I've invested in. And let's have a look at that. Before we talk about the brand new strategy, let's look at the two stocks I'm trading where I've got the natural positions that I talk about every single week. So the first one is Tesla. If we have a look, I'm shooting this actually in week 23, and Tesla's down another 11.41%. So my covered call I sold on Friday is probably worthless about now. So we'll go into the chart in a second. But as always, I do the screenshots of the trades so you can pause the video and check those ones out because obviously I'm trading a number of contracts different to this. So in this particular example, I sold it for $3.60 because I got 300 shares. That equates to $1,080 income coming through the board. And then that is actually wrong. Actually, I've just realized that should be at $3. So I've got 3 contracts there. So my net is 1077 for the week on Tesla. So as you can see, I've rolled down from 192 to 157 and rolled down to 130. And as I mentioned, Tesla's trading at 109 in week 23. So this option is definitely going to expire worthless. So there's 2 things I want to show you here. The first thing is Tesla has missed its last 3. Well, it's definitely going to miss this pivot in coming back to, what's that, 134 in the next 2 days or so. It's missed its last 3 pivots. So this is a strong indication that we're going to get some sort of a pullback to normalization to continue either to go down or either to go up. It has to do something now. It's getting extremely oversold. Another reason why it's extremely oversold, if you look at the RSI down here, and you look at this column over here, as I can't take a screenshot of it. If you look at it, it's at 12.59. And you can see, look how low it is compared to wherever else it's been. It's been extremely oversold. And this new indicator that I've got on, which helps you explain more of the current strategy and the new strategy that I'm deploying, but it's still relevant for options. You want to sell options in high implied volatility, and this is just measuring Tesla's implied volatility. And you can see generally around earnings time, high implied volatility is high. But this year is the highest implied volatility Tesla has been throughout the whole year. And you can imagine it's dropped 40% in like a month, right? So you expect the volatility to be high. But similar to price coming back to its averages, is implied volatility is a mean reverting asset. As you can see, it goes down and it goes up, right? So what I've done in the new strategy, and what I'm also doing now every single week, is I'm selling options in high implied volatility times. So therefore I can get wider ranges or do covered calls a lot higher and get the same amount of premium when it's in these levels over here. So we'll go on to that in a second, but I just want to show you what this was while we're on the chart. But going back to where we are with this particular covered call, is I generated 1,080 at the 130 mark. You know, because implied volatility is high, I think it's still going to be fairly high over the next couple of days or so. I believe that I'll still be able to roll this at a decent amount of premium. I'll probably have to roll down again, you know, but the more it'll roll down, eventually price will come back here and I'll get into a bit of trouble. So I'm preparing for the trouble that's coming, because Tesla can't continue to go down. It can do, but it's very unlikely. It has to pause at some point. I would be very nice with a pause right about now, but let's just see what happens as time goes on there. As you can see, pre-market, what is it? It's up $1. It doesn't really make that much difference from there. So that's Tesla. From there, if we quickly go to Meta, I've been stuck in this covered call below my cost basis now for a while, and it's actually losing me money. And I've got like 10 grand stuck into here and it's not really doing anything. So the current price is 116. I have a covered call expiring this week at 96. And you can see what I did last Friday is I just netted myself out $30. So I've got, well, I say $9. I've got 27 grand invested, making me $30. So if I go back all the way to November, right, I made $139 on 27 grand of capital. That's tied in, which is not great. I should be making, you know, $400-500 a week here. So I really need to do something about this. And I need Meta to drop. Even though I own 200 shares at 139.50, I need Meta to drop. And, you know, a few weeks ago, I said, you know, it has to come back down to this pivot. When it does, I'll be able to roll this strike up, because I need price to come here. I need my call to go there so I can sell, you know, even if it's at the money, to generate some sort of premium here, but because it's not really working for me. So as it stands, I'm quite comfortable with where it is. I can't see me getting called on this, if I'm really honest. It's not too far away from where we are, but you can see here, you know, we have just been ranging here, which is unusual when, you know, most of the tech stocks have still been selling off. Meta has had a massive sell-off, and, you know, it's kind of filling in its gap it left after earnings there. So, you know, we are where we are with it. Implied volatility is, you know, at its lowest it's been for a while. So it's not really doing that much Meta at the moment, which is fine. It's good for the stock to take a little bit of a break. So let's talk about my brand new trade. And it is on Tesla, but it's a different trading strategy. So what I've done is sold a short strangle. And what a short strangle is selling an out the money put and an out the money call to create a range. And I've done 2 contracts on this. So if I show you what this visually looks like on the chart, you've got a 90 put and 150. I'll just do it visually here. So it's about here-ish. So there is the call side, and 80 is about here. So what we've got, I sold an option here, and I sold an option here. And what that does is this creates a boxed range where I need Tesla to stay within as time goes on. Now, this option is the January the 20th expiration. And I'm not expected to hold this all the way up to expiration. What I'm looking to do is buy back these options around 50% of what I bought them for. Now, I did 2 contracts, right? So the total premium I collected was $922, which is why we have, a big amount brought in week 22. Because this isn't a realized P&L here. This is just the date that the premium hits your trading account. And so what's that? 450, 460. So what I'm looking to do is buy back these options when these options are worth as a total around $450. So that's what $1.20, $1.26, and $1.04. So I've got good to close orders in to buy back these options when these options depreciate by 50%. So why have I done this trade? No, but before I do that, so it cost me $9,500 in buying power or margin requirements to place these 2 contract trades, right? So that's why it's not the full amount of, 15,000 divided by 2. It's just the way IBK work in terms of its margin requirement to kind of place this trade, because Tesla can't finish above both of these strikes, right? Tesla can either finish down here or it can finish up here. It can't hit both. So one of these options will expire worthless, which is why you can place both legs of this trade for the same amount of margin requirements, because both options can't be in the money. So the reason why I placed this trade is, one is diversification of the option strategy. I've got capital to employ. A lot of you guys have been saying just sell a put, which is what I've basically done. I've sold the $80 put. But what I've done is I've also sold a call as well, because it's the same margin requirements. And secondly, the reason why I've done it is because implied volatility is at its highest it's been for the past year. Now, as this goes down, the option, regardless what happens, even if the stock gets to here, right? But if implied volatility drops back down to these levels, my option will still be in profit, because as volatility contracts, the price of your option also goes down, right? And what we have here is a thing called delta, controlling your delta. So I think that this was sold at the 15 delta and this was sold at the 15 delta, right? So my bias on this trade is basically 0 or delta neutral, right? So even if the stock, not really fussed on the direction, whereas when you sell puts and covered calls, they are a bullish strategy. You want the stock price to go up. So what I've got over here is I've got a delta neutral strategy. So if Tesla continues to go down, if I just had a put on, this put price will go up, right? Even with the call, my put price will still go up, but it will only go up. It won't go up as much because this call is actually making me money, right? So as the price goes down, the price of this option goes up, but the price of this option goes down. So it's neutralizing to a certain extent the downside risk. If Tesla starts doing this option will decay in value and this option will decay in value, and therefore my profit would be a lot higher. So I know this might sound a bit complicated, and I'm doing a lot more videos on what's called a short strangle. This is the option trading strategy. But the key thing for you guys to know at this particular point in time, if I get rid of all of this stuff, is to watch where Tesla goes, right? So not only what happens to the price, but what also happens to the volatility. So over the next couple of weeks, as this kind of option kind of plays out, what I'm hoping is, even if volatility goes, even if it moves a lot, because I've sold it over here at its near enough all-time highs. It's probably around here-ish, actually, as I sold it last week, and it's gone even higher since then. But that's what we're looking for. We're looking for volatility to contract. And what I like about this is that I've now got more upside room here because I sold it right bang in the middle. And I do think we are a lot oversold. So even if we get a little pop and then volatility comes down, that is really going to help this option deteriorate in value and therefore increase my unrealized profits that I've got so I can buy back these options for quicker. So that is why I'm doing this trade, for capital efficiency and also taking advantage of the high volatility that we have inside the market. So I hope that makes sense. So more as we do more of these, and I'm probably going to revert more to this type of strategy than straight puts and calls and the wheel strategy with longer explorations and all of this stuff. This is stuff that, I've incorporated in my other portfolios that I have, and it's working really well, especially in high volatility environment. So I really hope that you've enjoyed this video. Make sure you like and subscribe. Check out the playlist on the screen now, as well as my rolling playlist as well, because rolling is a bigger part of this, because this is all what I do. And I should see you guys in the next video.